I have been a financial advisor got into the industry in 2001, 2002, and made it through the crash in 2008. And I actually had clients starting to ask new questions that they had never asked before coming out of that, like, how do I get my money off of Wall Street? Our mission is to nurture the growth of the social impact economy, and it is comprised of companies that are doing well and doing good at the same time. So we nurture that growth by providing research, education, and advocacy. So in the past, starting in the 1930s all the way up until about 2012, this started to change. If I was an entrepreneur and you were a potential investor in the community, I had to know that you were what's called accredited, meaning you had over $1 million in net worth, or you made more than $200,000 a year in annual income, or $300,000 in joint annual income. So I had to either know you were accredited, or if I knew you were not accredited, or it was questionable whether you were accredited, I had to know you personally, and that was the only way I could approach you to ask if you'd like to invest in my business. And I could absolutely not, take out an ad in the newspaper and say, I'm raising capital, anybody come to the table that's interested. So that meant that the way that our local capital markets developed then was that people who were higher net worth had access to quality companies who were coming up and good investment opportunities. And on the flip side, those entrepreneurs who had connections through their family and their friends had access to those accredited investors and could more easily get the investment that they were looking for. Well, considering that only 7% of Americans are accredited, it turned into this two-tiered system of haves and have-nots, where if you grew up in a socioeconomic bracket that didn't have those kind of connections, you were locked out of the system. So we ended up with this economy in Michigan that is very focused on, those high growth businesses. And we understand and appreciate why the state and all of our institutions have gone after that sector. But those businesses and those investors make up less than 10% of our businesses. The other 90% of businesses were sort of left out of this whole system. That's when individual states started to say, how can we reduce the barriers to entry for both investors and entrepreneurs? And that's happening in Michigan now with the MILE Act. If you're going to use MILE, you file a one-page notice filing with Lansing, with the Licensing and Regulatory Affairs Division. You pay a $100 fee. You submit your business plan and your financial projections and the terms of your deal. So is it debt, is it equity, what is it? So you have full disclosure, you have to put everything on the public record. These are all the documents that you're going to show to potential investors. And then you need to meet what's called the 3-pronged 80% rule. You have to be Michigan-based, you have to have 80% or more of your assets, your business assets in the state of Michigan. You have to have 80% or more of your revenues being generated in the state of Michigan. So Michigan sales tax is being triggered. And you have to use 80% of the capital that you raise in the state of Michigan. You file your notice filing, you pay your $100 fee, you submit your documents, and then you go raise your capital. You can raise your capital offline, low tech, through conversations or presentations in the community, or you can do it online through one of the platforms that are available. You have a 12-month window to raise the capital, and if you do not have audited financials, which most small businesses don't, you are capped at $1 million per year that you can raise. And if you have audited financials, you can raise up to $2 million, and that's per year, so you could keep doing capital raises as you grow. So that's the gist of MILE.